Thanks. Welcome also on my behalf, everyone who's here. It's really nice to have a group like this. So yeah, and thanks for the previous presentation. I think that this will complement in different ways. So I'll just start with a very broad definition. What is unequal exchange? Unequal exchange is an exchange, meaning a trade, a market trade of non-equivalent quantities, meaning of uneven quantities of value. And then what does value mean? It can be defined in terms of hours of labor, of environmental factors like hectares of land use or energy use or raw material use, etc., water emissions, etc. Embedded in trade, meaning it's looking at all the resources that have been expended to produce the services and the goods that are then traded. And the definition continues by saying that really when you want to think about inequality in trade, you would have to consider all these different factors because one country might exchange more labor time in return for more land use somewhere else. How do you consider that a country is suffering from sort of unequal exchange or not? You need to consider the whole package, is according to this definition. I'm not going to talk today about the theoretical origins. That would be too much. So I'm going to focus a bit more on the empirical work. But here are three, just to mention them, there are three key theoretical sources that have been thinking about this in the 1960s and 70s already. A more Marxist approach, meaning focusing on labor, on the hours of labor time that are flowing, that are embodied or embedded in the trades that are flowing around. Then there is an economic post-Keynesian approach that looks more at currency. I'll explain a little bit about what that means empirically. And of course, there's the ecological approach, looking at all the raw materials, energy, etc. Now, unequal exchange, the basic starting point is that you could say there is a sort of financial imbalance. So this could be measured. Currently, the best way to measure that, what is the financial imbalance through trade, is to look at what's called the domestic value added. The simple version here, and it's very simplified, is Peru. Peru might export gold that is worth 45 million. That's the total exports value, but it had to spend 25 million on importing mining equipment. That would be the foreign value added here, the green part of worth 25 million, so that in the end, Peru actually only earns 20 million from its gold. And that's the domestic value added. So the thing to remember here is domestic value added basically means the money that the countries capture or profit in the end through trade. And here's then the empirical sort of result of that, the financial imbalance, the growing inequality between the red line here, the high-income countries, which are capturing most of the financial gains, returns from trade, compared to the other groups. So you see a growing inequality since 1990 up here to 2022. See in the table, the ratio has increased of the inequality between the high-income countries on the one end, and here I've combined the low and lower middle-income countries in one, but the gap between high and low income countries is even wider. So you could say, okay, there's a growing gap in money captured from trade between the global north, let's say, and the rest of the world. And you could see this as a form of economic unequal exchange. Now, this is a sort of superficial measure because the theory of unequal exchange says, well, there are also actual losses. Here you see that even the low-income countries line is actually increasing a bit. So someone might say, well, everybody still benefits from trade, even though maybe the returns are unequal. So let's look at some of the other dimensions of unequal exchange. Here is one method based on material flow analysis. And that the long story short is, let's say the Netherlands imports 10 million tons of camembert. Those 10 million tons might embody a lot more resources, energy carriers or minerals that have been used to produce the machinery that eventually produced the camembert, all the materials that were used in agriculture. So maybe 10 million tons of camembert actually embody 20 million tons of total raw materials use for producing that camembert. So the Netherlands might be importing indirectly a much bigger sort of footprint. So that is what a material flow analysis tries to estimate. I just want you to remember this sort of, you could call it the embodied resources. And in material flow analysis, it's called the raw material equivalent, but it's basically all the resources and energy and minerals and metals and whatever that have been used in production all the way upstream, right? So it's sort of connecting through the different supply chains, all these raw materials, all the way to their sources, let's say. So with this, you can assign responsibility at the end, at the final consumption of the camembert. This country is responsible for having used up all those resources all the way up to all the supply chains that eventually led to this camembert. Now, if you then plot that over time, this is indeed the graph this is from our colleagues Christian Dorninger and Alf Hohenburg and others that have looked at the trade in these raw materials, in these embodied raw materials. And you see that the purple line here is the high income countries. They have basically net imported all these raw materials from the rest of the world. So when you're above the zero, that means you are importing more of those all those embodied raw materials than you are exporting, meaning you are basically draining the rest of the world. And the rest of the world is below zero, meaning they're exporting more than they're importing over time. And this approach has the same paper expanded it to look not just at raw materials, but also at energy, at land, and also at labor. I'll come back to labor in a second. We did a recent update of that, basically finding roughly the same thing, except a further widening of the inequality in recent years, an interesting trend with China. And we have also compared how many of these raw material equivalents are being exported relative to how much a country has in domestic extraction of those resources. So the low income countries, this blue part here, they consume 13.3 less raw materials through trade than they domestically extract. Meaning that they export more than they domestically use, and the high-income countries is the opposite. So they import 24% more than they domestically extract. So they rely on resources from the rest of the world, as we know, to a large degree. And you could say, okay, this is from a purely biophysical material perspective, the imbalance that ecological unequal exchange tries to show, the purely ecological material-based unequal exchange. So we have a financial one, we have a biophysical imbalance, and now we get to the labor imbalance. This is a paper from Jason Hickel and his colleagues that came out recently that looks at the labor time that has been devoted to produce these export goods and services, and where they are flowing from. So here you have a graph on the left from a southern perspective, the global south. It's a big category. It also includes China. Exports around close to 900 billion hours of labor time. But it imports less than 100 billion, maybe 80 or something like that, billion, 80 billion hours of labor time. So a huge imbalance. So a lot of the human effort that is devoted to producing goods for export come from the global south, right? It's 90% or something in total that is coming from the global south. On the right, you see a little table that where we've attempted to update the data. It shows the same thing, except it's gone further. It's the difference has grown further up. So this is the data comes from Exiobase, one of the data sets, these input-output data sets that Johan mentioned, by the way. Now, the last imbalance that we need to consider is the currency imbalance. This comes from these post-Keynesian sort of approaches. It basically says that if the explanation behind it is, it'll take a minute to explain. If you have a US dollar in your hand, you go to India, you go to an exchange office, you get 79 rupees. However, with those 79 rupees, you can buy more stuff in India than you can buy with a dollar in the US, right? So then you have this adjustment, this price level adjustment on it's called PPP, purchasing power parity, which has recalculated what a dollar is worth in real terms. So actually, what this calculation says is in the US with a dollar, you can buy some stuff, and you can buy the same kinds of stuff in India with only 21 rupees. So that's another sort of exchange rate that adjusts this. Now, so this is, for example, used for these extreme poverty calculations that Jan was mentioned in the first slide. Now, what does it? So these price level differences are fine as long as there's no trade, because consumers and producers are just buying and selling in the same currency. But when you start to move into trade, you get an imbalance. So first bullet here, India exports with a discount. It's basically India offers a discount, a hidden discount to the US, because if the US were to pay US prices to India, then India would earn 376% of what it earns now. So you just divide these two market exchange rates. So that's one loss. India exports at a discount. The other loss for India is that it imports goods and services with a surcharge. So it pays too much to the US. If India paid Indian prices to the US, India would spend only 26% of what it spends now. So there's this sort of reverse ratio of these rates. So that hopefully shows that sort of a double imbalance through these currency gaps, through the price level gaps between countries. Now, as the calculation in the table below is a sort of hypothetical. Let's say there were no price level differences. Price levels around the world were at the global average. So in this case, like US and India would sort of split the difference. And if you take that as an approach and you compare the domestic value added that is actually earned by the different income countries, the low and low middle income countries, the upper middle income countries, and the high income countries, there are the three categories in the table. If you compare what they have actually earned, this is in 2022, to what they would have earned if price levels had been the same, you get the total loss through this currency imbalance. So the high income countries earned 11.6, that's the top right little cell, 11.6 trillion US dollars in 2022. They should have earned actually only 8.5 based on equal price levels, which means that they gain 3.1 trillion only because they live in countries with stronger currencies, basically. And for the lower and lower middle income countries, it's the opposite, obviously. So they lose 100%. They offer 100% discount, basically, on what they're exporting. Right. So this is the last imbalance. We have the financial imbalance, just the differences in domestic value added. You have the material one, the resources and the water and the land use, etc., that is being drained from south to north. And then here you have a currency imbalance, and these add up together. So there have been some efforts recently to try to link up these different forms, these different imbalances. I'm not going to explain exactly how it's done, but it's basically saying, okay, we have a monetary imbalance, we have a labor imbalance, and we have a resource imbalance, and take them together and explore what if it would take the same amount of labor time everywhere in the world to earn a unit of money with the same purchasing power, meaning to be able to buy the same goods. Again, it's this sort of hypothetical equal situation, and we're comparing it to the current unequal situation. We're also asking what would the monetary earnings be for a ton of raw materials if those price levels were the same? And then you get if you combine these imbalances, you get, as you see in the table, a much larger, a much more extreme unequal exchange with low and lower middle income countries actually giving a 420% discount on their exports, and high income countries also having what is it? An 8.9 trillion surcharge that they're gaining when you combine these things. So there's some references below of authors trying to do this combination. Now I'll end with this. It's just one little attempt to at least conceptually start to combine a little bit the things that we've been talking about in the three presentations, and I'm really curious to explore much more in the discussion because I think that this could be a very interesting question. So the donut has been discussed already by the two previous speakers. Here, there is a sort of country-based assessment of how the different countries are doing. So on the vertical axis, you see, are they sort of managing to achieve the inner ring of the donut, these social floors? How are they doing? If you are low on the vertical axis, countries are not managing to reach those minima, those social floors. So you could, a comparison with DLS would be those countries that have a bigger gap in DLS, if you could compare that. And as you move up along the axis, then you are achieving more and more of these minimum social floors. You're doing better from a social perspective. But then what is happening also is that countries tend to go more towards the right, which means they are overshooting more and more planetary boundaries. So the impacts, the environmental impacts, the environmental pressures are high when you're on the right side, Canada, Australia, US, and they're lower when you're on the left side. So ideally, of course, you want to be in the top left corner, Costa Rica, Mauritius, where high level of social floors have been achieved and low levels of environmental impacts or planetary impacts. So there's a lot of information in this graph side, the colors and the bubbles. I won't go into that. I've got a little explanation here at the bottom right, but I just want to show this sort of trend, right? So a lot of countries are underperforming socially, and a lot of countries are overshooting ecologically. But what I think is missing here, and I think this is an interesting connection also potentially between DLS, environmental impacts, is the story of unequal exchange, because these groups are connected through trade, right? It's not just the domestic extraction of resources, that the domestic stocks. Through trade, countries rely on stocks, on natural resources and land, etc., from other places. So it could very well be that, if you say it very simply, that the under-consuming countries are partly, at least, under-consuming because a lot of the material resources, but also the human effort, the energy, the work, a lot of the money flows are basically being drained from these places, making it difficult for them to achieve, for example, decent living standards, because those resources are funneled through trade to the high-income countries, to the maybe over-consuming places of the world that are most responsible for also overshooting the planetary boundaries. So I think I'll leave it at that. This is maybe just a little input for later, and it was a sort of initial attempt to combine a little bit of the different presentations. I'll stop sharing here.